Good morning, everyone. I am Anuj Kumar Sabha, Chartered Accountant. So, in today's class, we are going to discuss about capital structure theories. So, out of all the capital structure theories, in this video, we'll be discussing about three capital structure theories, that is net income approach, net operating income approach, and traditional approach. So before we discuss about these approaches, let us first do some discussion about the meaning of capital structure theories. The meaning of capital structure theories. See, capital structure theories discusses about the impact of the capital structure, the impact of the capital structure on the cost of capital, and then on the value of the firm. So in capital structure theories, they discuss about three components. One is about the changes in the capital structure, the cost of capital of the company, and then the value of the firm. So among these theories, the capital structure theories, the capital structure theories has been classified into two categories. One is called as capital structure relevance theory and capital structure irrelevance theory. So capital structure relevance theory says that whenever the capital structure of the company changes, that is the percentage of equity and debt in the capital structure changes, then this will cause a change in the cost of capital of the company. So here KO means the overall cost of capital of the company, or weighted average cost of capital of the company, or the discount rate of the company, or minimum required rate of return of the company. Now capital structure changes will change the cost of capital of the company, and cost of capital of the company will change the value of the firm. Now, if this is happening, then such a type of theories which are discussing about this is called as capital structure relevance theories. And there are some more theories which says that your capital structure will not decide the value of the firm, which means the changes in the capital structure will not lead to the change in the cost of capital of the company, and this will not lead to the change in the value of the firm. So your changes in the capital structure will not change the cost of capital of the company. So if your cost of capital of the company is constant, then the value of the firm also remains constant. It will not change. Such a type of theories are called as capital structure irrelevance theories. Right? Now let us come back to our discussion about the net income approach versus net operating income approach versus the traditional approach. Now listen, before going further, net income approach is a capital structure relevance theory, right? And net operating income approach is irrelevance theory. And traditional approach is capital structure relevance theory. Now first, let us discuss about this net operating income approach. See here, the first point is net operating income approach. Sorry, net income approach is a capital structure relevance theory. Net income approach is a capital structure relevance theory. So already you would have known about the assumptions under all these approaches, that the firm has only two types of capital, that one is debt, another one is equity, and there is 100% dividend payout ratio, which means whatever the profit that has been earned by the company will be given as dividend, and it has been assumed that there are no taxes. So these are some of the assumption under which this theories has been discussed. Okay, so now for all these theories, these concepts or these assumptions will be common. So let us discuss about this first approach, which is our net income approach. So net income approach is a capital structure relevance theory, which means the changes in the equity and the debt will change the cost of capital, and changes in the cost of capital will change the value of the firm. Right? Now, here it has been assumed that there are only two types of capital. One is the debt and second one is the equity. Now, cost of equity is called as the KE, okay, and the cost of debt is called as the KD. And here, WACC means the weighted average cost of capital, or it is also called as the KO. Listen, in this approach, they are saying that a business, whenever it start increasing the infusing the debt into its capital structure, just a minute. Right. So, whenever the company starts infusing the debt into its capital structure, then slowly the weighted average cost of capital reduces. Now, why this is happening? Now, why this is happening? See, whenever the debt has increased in the capital structure, then the portion of the capital is more inclined towards the debt. Now, as we know, the debt is a cheaper source of finance. Okay, here also you can see that our KE is greater than KD, which means cost of equity is higher and cost of debt is lower. So whenever the company starts infusing the capital, debt capital into its capital structure, then the capital is more and more inclined towards what? The cheaper source of finance. And that is the reason why here you can see there has been a decrease in our weighted average cost of capital. Now, weighted average cost of capital is represented by KO, which means we are saying that whenever you change your capital structure by including the debt in your capital structure, then the KO changes. That is, KO reduces. Now, whenever KO reduces, the value of the firm increases. Why? Because there is an inverse relationship between the KO and the value of the firm. So whenever your KO increases, the value of the firm decreases. Whenever the KO increases, then value of the firm decreases. And whenever the KO decreases, the value of the firm increases. Right? So here, since there has been a decline in the overall cost of capital of the company due to the debt, the KO have reduced, thereby the value of the company have increased. So this is all about our net income approach concept. Now let us come to our net operating income approach. So net operating income approach is a capital structure irrelevance theory, right? Capital structure, it is a capital structure irrelevance theory, which means the capital structure of the company will not influence the cost of capital and cost of capital will not influence the value of the firm, right? So here you can see that there are two types of capital again. There is equity and debt, and cost of equity is represented by KE, and cost of debt is represented by KE. And overall cost of capital has been represented by KO. Okay, this is also called as weighted average cost of capital. So here also the KE is greater than KE is greater than KD. Now listen, here what happens is as the firm increases the capital, means debt capital into his capital structure, in that case, the KE have increased. The KE has increased. Here you can see the KE has increased, right? Which here it indicates that whenever the cost of equity have increased, it will set off with the benefits that the company will earn due to the existence of the debt. Why? Because here we have seen that due to the cost of debt, what happens? Due to the debt in the capital structure, what happens? Your weighted average cost of capital have reduced. Now, this reduction is nothing but a benefit to the firm, right? This reduction is a benefit to the organization. Now, at the same time, what happens? The cost of equity increases. So, your weighted average cost of capital again becomes straight. So, which means the benefit that you got due to the debt capital, due to which your overall cost of capital have reduced. Now, at the same time, it increases the financial risk to the shareholders. It increases the financial risk to the shareholders. Why? Because see, whenever more and more debt is coming into the capital structure, in that case, whenever the company is earning the operating profits, out of the operating profits, first payment has to be made to the debt providers, right? In the form of interest, right? EBIT, and then from EBIT we reduce interest. Now, whenever your debt increases, interest portion also increases, which means the profits available to the equity shareholders decreases, thereby the risk of the equity shareholders increases. Okay. Now, in this approach, the reduction in the cost of capital due to the existence of the debt is a benefit to the organization. Now, at the same time, what happens? The KE have increased. These two will offset to each other. So your declining KO will again become straight, which means it will remain constant. Now, whenever your KO remains constant, then obviously what happens to the value of the firm? It also remains constant. So whenever your KO remains constant, so automatically your value of the firm also remains constant. Okay. So that is the reason why this is called as what? Capital structure irrelevance theory. Okay. So your KO is constant here. Obviously, your value of the firm is also constant. So the changes in the capital structure has not influenced the cost of capital of the company, and this has not influenced the value of the firm, right? So net operating income approach is also is called as what? Capital structure irrelevance theory. Now let us go into our next approach, which is our traditional approach. Now listen, what happens in traditional approach? First point is traditional approach is a capital structure relevance theory, right? So our traditional approach is what? A capital structure relevance theory, which means if there is any change in capital structure, this will influence the cost of capital of the company. And if the cost of capital company changes, then it will lead to a change in your value of the firm. Okay. Now, in short, this traditional approach, we can say it as it is a combination of net income approach plus net operating income approach and plus certain additional points. So in net income approach, we said that whenever is debt is introduced into your capital structure, your KO reduces. And then in net operating income, we discussed that due to the increase in the financial risk of the shareholders, the cost of capital of the company remains constant. Now, traditional approach is also combining both of them and is saying that yes, those two are correct only, right? So, whenever your debt is infused into the capital structure, then your overall cost of capital decreases, and after a certain point it remains constant. And the additional point here is traditional approach is saying that if beyond certain limit if beyond certain limit the debt has increased in your capital structure, then not only your KE increases but also your KD increases, right? Not only your KE increases, but also what happens? KD increases. In earlier two approaches, we have seen that KD is constant, right? KE has increased, and in another approach, it has remained constant. Like in net income approach, it is constant. In net operating income, the KE has increased. So beyond certain limit of debt, what happens? See, anyway, there will be change in the cost of equity. It will increase due to the increase in the financial risk of shareholders. But beyond certain limit, what happens? Cost of debt also increases. Why? Because more debt in the capital structure will cause bankruptcy risk or insolvency risk to the company. So KD also is going to increase. See, it is as simple as this. Up to a certain limit, your KD will be constant. Now you go further to the banks and ask for the loan, then banker will say that no, already there is a lot of money given to you, so you need to first repay that. So if I give you a fresh loan now, then it will not be given at the older interest rate. Here the interest rate will be higher, due to which certain point only the KD will be constant, beyond which it is going to increase. Cost of debt will increase, right? Now whenever your KO, this is our KO. So as per the net income approach, what happens? Your KO reduces, and as per the net operating income, your KO will be constant. And beyond certain limit, if it debt is added, then it will also start increasing. Your KO also will start increasing. Have you all understood this point? Up to a certain limit only, your KO will decrease and then KO will become constant. Beyond that, if you keep on adding the debt into your capital structure, then KE increases, KD also increases, and KO also starts increasing, right? So obviously, whenever the KO increases, matlab cost of capital of the entire company increases, this will lead to decrease in the value of the firm. Why? Because there is an inverse relationship between the KO and the value of the firm. So as the cost of capital of the company increases, the value of the firm decreases, right? This is the concept which has been given by our traditional approach. So this is all about this video. If you have any doubts or if you want any other specific topic in the world of finance, you please mention that in the comments box, right? Thank you so much. Have a nice day.